Welcome to TradeTheNBI.com. This is John. This reports for the 27th, and we start off the new week. Well, after Friday's burst above the 23%, was all buying from there, and of course, has to be super cheap given the fact that, look at where we were, and people were willing to buy up at 4,300. So why wouldn't you be buying at 36? And even more so, why wouldn't you be buying all of it if it's just a transitory event? Well, 38% looks like would be the tough spot for it to overcome, which, if you look at from a daily standpoint, is somewhere around the 39.70 range. Well past 38.50 because of the momentum of that buying from the 38.44, the propelling of that just kept pushing. But we can see shorts already starting to activate a little bit here. And I would imagine as we get closer to that 38, they'll kick in even further. Already seeing a dip in the NBI magenta coming down here, so if that continues to progress and white rising would certainly be a problem. What we'll look for is the beginning of a shakeover roller, particularly as we get towards zero, because that becomes a critical one. If it rolls over around zero, then we're in for a nice, good swoop lower. NASDAQ looking pretty close to identical, but here it's more in that danger zone where you can see the white NBI starting to perk itself up, and the closer it gets to 25 for that number is going to be critical. And we're already seeing the spider effect where cyan crosses above the green here, and then you end up with your four little legs. So keep an eye out for that one as well. No steel reset either, so again, the sustainability of this rally is questionable. And it's not that it wasn't overdue. I mean, you have quite a few people positioned to the negative side of it. But whenever you capture that, you throw off those imbalances to try and reverse things. There's still a couple of days left in the month for some window dressing so that they don't look like they had a horrible month. And from a euro standpoint, the support recognition of that 103 range from central banks pretty strong. So it's kind of holding up above that 104.8 range, the 23%, and still trying to push forward. So they're still looking for some justification that anything euro is attractive, which it's not. So it's kind of folly. And again, that battle between this idea of deflation and that's fine. You're going to get some areas where there will be some, but at the end of the day, another couple months persistence of this with food prices and that what they're going to start to turn into, I don't see anywhere but upward for gold at that point. There's just no way to do it. And of course, they were very anxious to try and ban Russia from, they had already done it from the regular markets for trading, and now they're like, you can't even buy Russian gold, which, I mean, that's kind of crazy because they'll just sell it to other countries who can either repurpose, stamp it with their own name. So it'll be interesting to see if the Russians sell at a discount. I doubt they will because they've been net acquirers of gold and it's really done well for them. And it's going to be easy to see the effect because, as we've already noted, post-sanctions, the ruble's starting to rise. The question is how long it will take them to transition their economy out of some of that Western trade. That could take some time, and it's definitely going to create some stumbling blocks. But the question is, the contraction that you're going to see in Russia, is it going to be any less, or will the West contraction be even greater? That's the real calculus. At that point, it wasn't worth it if the West suffers greater. Of course, they'll want to blame inflation and everything on Putin, but at the end of the day, we all know that just isn't the reality of it. This was created long before Putin came along and started before he came along, and only their choices have exacerbated it. So it's going to be a complicated time coming up, and I don't think people really starting to pay attention to how fast prices are going to start rising towards the fall. And so it's something to be prepared for. From an oil standpoint, again, 107, this is still going to end up looking cheap probably in another couple of months. So we'll see how that goes. Now, of course, if you destroy demand enough, you have the opportunity there to do it. But that's really, I don't think, what the Fed is hoping to do, because creating an absolute collapse right before the midterms would not bode well for some. From a Treasury standpoint, of course, rates are going to continue to rise. It's going to have to continue to drop. And if we drop into the low 105 range, that's going to get real interesting because we haven't seen those levels in forever for interest rates. Bitcoin, still been staging a rally, but of course, actually, I should just put up the daily because you can see. Okay, so yeah, big rally. Not really doing a whole lot of anything from the original sell signal that happened. Well, that was all the way up at the 46,000 range, so there you go. Have fun with that. And from an ETH, again, excellent range. And so if you're playing in cryptocurrency, I think that ETH happens to be one of the best ones around as far as our ability to capture its moves and see clearly. So the flip in color from a 50K standpoint, perfect on that, and went nicely. From an intraday standpoint, it was pretty boring Friday because once we started up, there really wasn't a whole lot of collapse. You can see how that MBI Magenta stays around the 25, keeps popping back up, and so every one of those becomes new opportunities to add into the rising setup. And then because of that, you had a series of positive extremes, and there's still quite a few of them. And, just some of them are marked, even marked the most recent ones, which come in right about here at the 38.40 range in that. So that would be where the expectation for pullbacks in some of those, and then every single one of these additional increased ones. These later ones have been filled already that happened towards the end of the day, and filled them back in and then popped back up from there. So currently we're in a little bit of a weak phase, but as you can see, there is plenty to fill down below. That's just going to be a question of how long that takes and how erratic the move is, because I think there's just so much uncertainty that we're going to get a lot of that up and down until there's well, I guess you could call it consensus, but I think that's going to be hard to come by these days given the disparity in viewpoints. Of course, the Fed is in a la-la land that doesn't exist, and since they control the money and they have great influence over everything, but practical situations will start to take hold as real numbers start to develop, and that's where it's going to become interesting. When you go look at real estate, we're going to see home sales. Certain areas are really being affected hard. Is that going to have a contagion and spread? Is it going to be limited? What is the capacity of the consumer to adapt to the changing prices with wages not moving as fast? These are the unknowns that are going to be resolved, and I think a lot of people are saying the potential for downside is far greater than the 36 range or lower. Could be in the 28 and 24 range. So we're just going to see how the numbers escalate. And again, this is where that contagion cascade effect becomes quicker. So I keep an eye on the credit markets because it's that inter-party risk between the two that really becomes a telling situation. When you start to stop trusting the counterparties, things start to fall apart fast, and fast really can create a problem because now you don't have that liquidity that everyone can just keep borrowing for free to keep adding to positions. That's sort of gone. So it makes it a lot tougher for the bulls that used to just be able to just keep going and going and going. So we'll see how it unfolds with that, but we're going to keep following the indicators. Pretty good for so far, so no objections. As always, trade well. We'll talk to you later.